I want to thank everybody for joining me. This webinar is at least 7 things tax-savvy investors should consider before year-end 2020. I hope that you find these helpful. There's a number of things that I've actually added a little bit more in terms of things that you can do between now and the end of the year to potentially lower your tax bill. So this is a quick list of the things that I'll talk about. Tax loss harvesting, some different ways to make charitable donations, Roth conversions, leveraging tax rates for bracket stuffing, which kind of ties into Roth conversions as well. Roth IRAs for your children or grandchildren if they work. Be careful about mutual fund purchases, the advantages of healthcare savings accounts, and diversifying account types or asset location. So the first thing we'll talk about is tax loss harvesting. So tax loss harvesting, if you do not have a taxable brokerage account, this will not work for you because transactions in a non-taxable brokerage account, a tax-deferred account, are not subject to tax. But if you do have a taxable brokerage account, even when the market goes up significantly, it's nearly impossible to have every investment work in your favor. So you're going to have some disappointing investments. So tax loss harvesting is a way to take advantage of those losses. Realize some losses. If you've had gains during the year, you can offset them. You can also take up to $3,000 of capital losses in a year and write those off. And if you have more than that, they can be carried forward forever. Also, this is relevant if you're rebalancing your portfolio. It's another way that you can use tax loss harvesting to help. So let's go through an example of what it is. Let's say that you have stock of ABC company that you bought for $1,000. It's currently worth $5,000. So you have a $4,000 gain. We assume a 15% tax rate on that stock sale, we would have a $600 tax bill. But also assume that you hold shares of company DEF. That one cost you $4,000, but it's now worth only $1,000. So you have a $3,000 loss. Your net gain between the two is $1,000. So instead of paying $600, if you sold DEF and ABC, you would only have a net tax cost of $150. Some things to keep in mind. Again, for tax loss harvesting, it only works in taxable accounts. You can replace the security that you sell with something similar, but it can't be identical or nearly identical, because if it is, there's something called a wash sale. And a wash sale basically says if we sell a security at a loss, we can't replace it unless more than 30 days pass. As I said before, you can carry over any unused losses. And also a strategy that you can think about is think ahead. Let's say that you have a stock that you've got a loss on, but you really still like the stock. Well, if I made the decision today that I wanted to sell that stock, some shares of that stock before year end so that I could recognize some losses, I could buy shares today, hold them for more than 30 days, and then when the 30 days pass, then I could sell the other shares, and then I'm not violating the wash sale rules. So you can kind of be ahead of the game, so to speak. Some don'ts. You do have to be careful about wash sales. Like I said, that's the 30 days. You can't buy or sell you can't repurchase a security you sold at a loss within 30 days. It can't be substantially identical. If it is, that can cause a problem. Also, you can't use a combination of your taxable and your tax deferred accounts and sell a security at a loss in a taxable account and then buy it in the tax deferred account within 30 days. That doesn't work. But also don't just let the tax tail wag the investment dog. And what I mean by that is don't let taxes drive all your financial decisions. If a stock is one that you should sell, then you should sell. And you shouldn't worry about what the tax cost is. If there's reasons to sell, there's reasons to sell. Next, we'll talk a little bit about charitable giving. So the first thing is there's one change this year. So I think it was early April, they passed the CARES Act. And the CARES Act was part of the stimulus that they gave and the help that they gave to people who are put in difficult situations because of the pandemic. And one of the things that they did is they said that even if you do not itemize deductions in 2020, you can write off $300 of your charitable donations as long as they're in cash. The first $300 you can write off even if you're not itemizing. The second thing is if you have appreciated stock and you are charitably inclined, you can take that appreciated stock and donate it instead of cash. The reason for that is when you donate appreciated stock, you get a write-off equal to the fair market value of the stock that you're donating, and you don't have to pay any capital gains tax on it. And then the last suggestion in terms of charitable giving is something called a qualified charitable distribution. So if you're more than age 70 and a half, and it's not age 72, which is the requirement for required minimum distributions, if you're 70 and a half or more, you can take money out of your IRA and directly donate that cash from your IRA to a charity. And if you do that, you don't have to pick that amount up as income. Now, you don't get an itemized deduction for it, but because of the fact that you get a direct deduction, it doesn't count in terms of your adjusted gross income. And it can have some benefits for you in terms of keeping your taxable income lower. It also can help you for Medicare purposes, what your income is for that as well. So there's some advantages. That's another thing that you can do with a qualified charitable distribution or a QCD. The next thing, and this one I want to talk a little bit more about, is Roth conversions. We have historically low tax rates. The most likely direction over the long term for tax rates is higher, especially because of the cost of pandemic relief and the size of the deficits the country has. Also this year, we don't have a requirement to take RMDs. So that means that the cost of doing a Roth conversion is less this year than it would be if you took the RMDs, because the amount that you might have had to take for an RMD, you could just take that directly as a Roth conversion. And then Roth conversions also remove the risk that potentially higher tax rates in the future could have on your retirement income. So when you're thinking about a Roth conversion, the things you want to think about is, what is your current tax rate? What might your future tax rate be? And I know that that involves some projection, but like one thing that I do when making that decision is I know what the rates are in 2020. I also know that if nothing else changes, the current tax law sunsets at the end of 2025. So beginning in 2026, for many of us, tax rates are going to be higher. So look and see what your tax rate might be in the future. That's one indication that you can use for that. Also, if you do Roth conversions, that means your RMDs in the future will be lower. And that means that you'll have lower taxable income in future years. Like I said, no RMDs this year. And then also a big thing to think about with Roth conversions is they have benefits for your heirs. So at the end of 2019, the Secure Act passed. And the Secure Act basically did away for most people with the provision for the stretch IRA. And what the stretch IRA meant was that you could take if you passed away and you passed your IRA money to a child, for example, and that child, you would look at their estimated remaining life based upon the life expectancy tables that the IRS uses, and then you would take that number of years and divide it into the value of the account, and that would tell you how much your required minimum distribution was from the inherited IRA each year. And that could be a lot of years. And if you gave it to a young child, we're talking maybe 60 years. But under the Secure Act, you only have 10 years to take those inherited IRA distributions. So it can really cause tax problems. If it's in a Roth account, you still have only 10 years to take it, but the person that receives it from you, they don't pay any tax on that amount. So here we're going to talk about leveraging tax rates and bracket stuffing. So for example, let's look at the table on the left, which is the 2020 tax brackets. And you'll see that if you're married, you have $300,000 of income, you're in the 24% tax bracket. If you look over on the right, you'll see the rates that would apply in 2026. And you'll see there that same $300,000 of income would have a 33% tax rate. So that's one thing to think about when you're deciding, do I want to do Roth conversions? Do I want to possibly recognize some income if I can in an earlier year? Think about what your highest rate is and how much income you can take to fill that bracket. And then also the other thing to think about with Roth conversions and with any other transactions that might accelerate income is when you're married, you get the married rates. Invariably, one spouse passes before the other. And typically, the income that you have passes to your spouse before it goes on to anybody else, so that you can make sure that they can maintain their standard of living while they're alive. Well, after you pass, they're ultimately going to be filing single. And when they're single, that means their tax rate's going to go up. If we look at the current tables here, we'll see that if you had income of $175,000 and you're married, you're in the 24% tax bracket. That's the top rate you pay. If you're filing single, that same $175,000 is going to be taxed at 32%. Another thing to think about is if you have children and those children are working, start Roth IRAs. Why? Because if your kids are working, they're probably not making that much money. So their tax rate's going to be pretty low. The money that goes into that IRA, as it grows, there's going to be no tax on it. When they ultimately are able to withdraw it, there's no tax on that. There are exceptions to this, and there are times that you can take out the money a little bit early, because the one downside of the Roth is that really they can't take money out until 59 and a half, but you can pull out your contributions at any time. There's a special 5-year rule that allows $10,000 to come out of your Roth IRA and go towards your first home purchase. And then there are certain qualified expenses that you can take the money out, you pay tax on the gains, but you don't pay any penalties for pulling it out. And that would be like for qualified education expenses or something like that. And the next thing to keep in mind, be careful about mutual fund purchases. Why do I say that? Mutual funds are required to distribute any gains that they've had during the year to their shareholders. Now, they do offset the expenses of the fund against the gains and against the dividends that the fund earns, but any amount over and above that has to be distributed. Those distributions typically take place in December. And if you buy a mutual fund today and you're holding it on the date that they declare the dividend, or the record date is the most important date, if you're holding it on that date, you're going to pay tax on that gain, even though you didn't benefit from it, even though you bought it today. If you hold it on, let's say, December 15th, when that dividend is declared and that record date happens, then you're going to end up paying tax on those gains, even though you didn't realize them. So if it's in a taxable account, you want to think about pushing something like that off until after they pay their dividend for the year. And I have a link here to an article that gives you some information from Morningstar on what kind of dividends a number or capital gains distributions a number of funds might be expected to make this year. The next thing I want to talk about, healthcare savings accounts. Some of you are still in open enrollment period. If you have a high deductible plan, a healthcare savings account can be a really good idea from a tax perspective, and it can really help your retirement and your financial planning as well. Some important things to remember about a healthcare savings plan: it's not a use it or lose it type account. You can put that money in today and it can sit there for years. And when you pull it out, you won't pay tax on it. You get a triple tax benefit because you get a tax break for the amount of money that goes into the account. It can be invested. And if it's invested, you get tax-free growth. And then at the end, you also get the benefit that you can pull it out as long as you have qualified medical expenses that you're paying for. And those qualified medical expenses don't have to happen this year. They could have happened at any time that you had that HSA open. As long as you have some type of documentation to support the expense, you can claim a deduction. And like I said, it's important to remember, there's a lot of flexibility in use. Like I've said to people, if you had an HSA in theory that you started in your 20s and you had it till you retired, after 40 years, if you had expenses over the years and you could substantiate those, you can in theory use it towards a new car or a boat or something frivolous or a big vacation that you wanted to take. It's possible as long as you have the expenses to support it. I also have a blog. Some of the amounts in terms of what the contribution amounts are and those type of things have changed a little bit, but it will give you a lot more information on what HSAs are and how they work. Next thing is something that's called asset location. Now, we often think about asset allocation, which is making sure that we have a diversified portfolio. That's important, and it can really impact your returns. But it's about more than just asset allocation. Like with real estate, the location matters for your assets. And what do I mean by that? You should have different types of accounts. You should have taxable accounts, you should have tax-deferred accounts, and you should have tax-free accounts. So a taxable account would be your regular brokerage account, and things like that. Your tax-deferred accounts, those are accounts like your IRAs, your 401ks, your 403bs. where you put money into those over the years, they've grown tax-free, but when you pull the money out, you pay tax on it. And then the last type is the tax-free. And what that means is those are the ones that when you pull money out, you don't pay tax on them. So while they're a little bit different because of how they're taxed up front, a Roth IRA and a health savings account are two examples of tax-free accounts. And then you want to think about the third part of asset location, think about which asset should be held in which type of account. Right? So interest, under current rules, interest is taxed at an ordinary tax rate, so your top tax rate. Dividends and capital gains have preferential tax treatment because they're taxed at lower rates. So you might want to think about, if I'm going to have capital gains, maybe they belong in my taxable account, or maybe they belong in my Roth, because if they're in my IRA, those capital gains, they end up getting taxed at regular ordinary tax rates, because when I pull money out of my IRA or I pull money out of my 401k, it's taxed as if it's regular income. So that growth that you would have had capital gains treatment for gets taxed at ordinary rates. The same thing happens with dividends. So you just want to think about what type of account you hold your investments in from a tax perspective. Now, we just had an election. Results are in, but nothing is official yet because there's still some disputes. But let's think about the future. What have we heard in terms of what could happen with a new administration? Ordinary tax rates could increase. Mostly that's talked about for those with higher income. Some things are at the $400,000 level. Some things are at the $1 million level. An important one to remember is the estate tax exemption, which is currently over $11 million per person and over $23 million for a couple. That could fall. Now, the IRS issued rules saying that if you use part of your exemption now, and then that limit falls in the future, that you won't be penalized. So if you have an estate that could be in jeopardy in terms of the estate tax exemption, if it was to be lowered, you might want to think about whether or not it makes sense to move some of those assets while the exemption is still high. Capital gains tax rates, as well as rates on dividends, could increase. They could become the same as ordinary tax rates for those with income over $1 million. Payroll taxes could go up because the Social Security fund is believed to be underfunded. I believe it's 2034, something around there, where we expect that if things stay the way they are, and that could be less because of the number of people that have become unemployed under the pandemic and lower Social Security tax collections. There's been talk about raising Social Security payroll taxes for those with income of over $400,000. And then the other thing that could happen is for those of you that have your own business, you get what's called a qualified business income deduction, or QBI, and that could be eliminated. And that was something that was brought into law at the end of in 2017. With that, that's the end of my formal presentation. As I normally do, I would like to open up to any questions that you might have. The last time I did one of these, some people were uncomfortable seeing other people on because I guess people were eating and some other things like that. I apologize for that. So this time I did it without video on, and I believe it turned off the audio. So you'll have to send any questions that you have through the Q&A, and I'll be happy to address them. And also, if you're interested in talking more about any of these things, you can sign up for a tax impact session. And there's a link to my calendar. If you're not on my distribution list, you're also welcome to sign up for that. And there's the easiest way to get a hold of me so that I can add you to the distribution list. I'm going to turn off my, that's it. So I did get a question, do you have to itemize to use charitable deductions? So the answer is generally yes. As I said earlier, I believe, this year under the CARES Act, you get the ability to write off $300 without having to itemize, but anything over and above that, you would have to itemize in order to be able to claim charitable deductions. I'm going to give you just another minute, and then if nobody else has any questions, I will end this program. And I want to thank you. Just so you know, I do these twice a month. The next one, since they're on Thursdays, comes on Thanksgiving, so I won't be doing one on Thanksgiving. So the next one will be in December. I will send out information about that when the time gets a little bit closer. I see a couple more questions came in. Is bond interest always ordinary income? Yes, as far as I know, I don't know any reasons that it would not be, Rich. And yes, when we talk about asset location, unless you need the cash flow that comes with those bonds, it does make sense to hold your bonds in an IRA where you don't have to worry about the regular tax. You don't have to worry about paying current tax. And I also see a question that somebody got in here late. Yes, this is recorded, and if you registered, you should have access to the recording. You should get information about that afterwards. If you don't, just send me an email and I'll be happy to make sure that I direct you to where you can find that. All right. Since I don't see any more questions, I'm going to end this now, and I want to thank everybody for attending. If you do have any questions, you're welcome to reach out to me directly. Like I said, and you're welcome to go ahead and put yourself on my calendar. Thanks for attending, everybody. Have a good night.